Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at a big deal in the M&A space that will create a mortgage behemoth.
Plus, we're going to discuss the rising costs of food and how that's affecting the consumer.
But first, we begin with research Bloomberg Intelligence recently put out on 10 companies to watch for in the second quarter of 2025.
And for more on this list, Paul and I were joined by Tim Craighead, Bloomberg Intelligence Global Chief Content Officer.
We first asked Tim to give us a broad scope of the company he's looking at.
So just as a reminder, these are all based off of focus ideas, which for us in Bloomberg Intelligence are high conviction, out of consensus views where we see catalysts ahead that can actually change the market's mindset around these companies. So we've talked about the weight on consumer sentiment and things along those lines. Well, Dollarama, which is a dollar store up in Canada, has, yeah, exactly. They're going to face slower wage growth, higher inflation. We've not seen estimate cuts yet for Dollarama like we've seen with Dollar Tree, dollar stores and whatnot. We think that's coming. Another one that is interesting, if you want to throw on as well, the whole tariff concept is PDD. You might not have heard of this, but this is one of the big Chinese companies that tech companies that trades in New York. They own Temu, which is that ultra low priced e-commerce platform in the States. There's even, their bigger platform is one in China. They're going to have constraints on what they can bring in at the right price. And they're also investing pretty heavily outside the U.S. to grow their non-U.S. platform beyond China. So again, we think that there's estimate cuts there to come.
Hey, Tim, looking at this list, one of the more controversial calls, I think, is Tesla. Steve Mann, you're the analyst for Bloomberg Intelligence covering the auto business. He's pretty positive on Tesla here, despite the collapsing stock price and I guess the concern about Elon Musk and his focus.
Yeah, you could throw this in with tariffs, with policy, et cetera, and clearly it's taken a shellacking from a stock price perspective. We see two things going on here. Number one, there's been a lot of talk about how their sales have been disappointing as of late, and is that because of politics? We think, frankly, it's because of the model transition with the new Model Y coming out. Orders, even in China, have been good, and we would expect to see sales to pick up as we proceed through the second quarter and on into mid-year. You've also got a really underappreciated battery storage business that is also starting to ramp up. So we see two catalysts here to play out that people aren't focused on because of all the other noise.
And here's one for Paul here. Cracker Barrel.
Oh, yeah.
Is on your list. Again, I've never been.
See, now, Tim, while he lives in
How
London.
could you not go to Cracker Barrel?
I grew up in New York City, man. Like, I don't know what I'm going to do.
See, Tim grew up in Southwest Virginia. He knows about a biscuits and gravy.
I mean, I'll eat it if you buy it and eat it. I mean, give it to me, I'll eat it. Let's put it that way. All right, talk to us about that.
It's really good.
I've heard.
Cracker Barrel falls into the restructuring, reorganization bucket. And there's another one on the list as well that actually may be good for you, Alix. I'll come back to. But Cracker Barrel, 3 years of estimate cuts. There's next to no buys on this stock. And from an underlying business perspective, they've made some wholesale revamps. The menu, their approach to service, they're remodeling stores, and we think that there's an inflection to come from the standpoint of earnings trends. Notwithstanding the economy, this one's already been beaten down, and we think that there's an upside to come. Caring's the other one.
Caring.
Now, Caring, yeah. So again, 3 years of estimate cuts.
Yep.
You think, who is Caring? Well, their biggest label is Gucci. There you go, Alix.
I see.
And
I only shop discount, Tim. Let's be clear. But
yeah.
go ahead.
So, new CEO at Gucci, a new head designer at Gucci. We think there's a rejuvenation at hand, and it's not in the estimates.
So again, Tim, let's just step back a little bit. European markets really performed well, certainly relative to the U.S. market. What are your clients saying here?
So I think there are a couple of things coalescing, three, in fact. You take tariffs and all the concern that's going on. You take DeepSeek and that raising the specter of, gee, is there a different dynamic in the world of tech that's been driving U.S. markets and U.S. exceptionalism? And then you have a big European defense initiative and imperative with Germany coming out with what people around here are calling the bazooka. And you add these together, there's a growth idea developing in Europe. There's concern about what's going on in the U.S. And if you look at our economists, they see as much of a hit on U.S. growth and inflation as they see it anywhere outside of Mexico and Canada. So, all of that weighs on the U.S., and Europe is an alternative. And obviously, we've talked a lot about how it's valued relative to the States.
Yep.
I think that creates a money flow issue, a money flow opportunity, just like it does for China.
Our thanks to Tim Craighead, Bloomberg Intelligence Global Chief Content Officer. Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance. They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport industries, buildings, and ag sectors. This week, we looked at the growing enthusiasm for nuclear power.
For more, guest host Isabel Lee and I were joined by Chris Gadomski, Bloomberg NEF lead nuclear analyst. We first asked Chris what his thoughts are on nuclear power as a source to fuel AI expansion.
It's a great technology for supplying clean, carbon-free, 24/7 baseload power. However, there's a mismatch between the demand for the electricity. Data centers say they would like to have the electricity right away, tomorrow, if not sooner. And any new nuclear capacity in the U.S. is not going to come online until after 2030. I mean, you may have one or two outliers come on beforehand, but before you have a reliable demonstration of the technology, because these are all new technologies being built, we'll be looking for after 2030. So possibly we could miss the first wave of advanced reactor contribution to the AI developments.
Why is nuclear construction in the West barely budging, whereas in, for instance, Asia Pacific region, it's booming?
Well, there's two big reasons for that. One, the price at which the Chinese, for example, can build a nuclear power plant is much lower than we can in the U.S. And that's a function of the fact that China right now is building 28 nuclear power plants. We have built 2 in the last 10 or 15 years. And so they will build 6 nuclear power plants at the same site. And the construction team moves from one reactor to the next reactor, the next reactor. Each reactor subsequently costs less than the first. So for China to build reactors for maybe 1/5, 1/4 of what the U.S. can build, it makes sense for them to build a lot of nuclear power plants. We've lost the expertise and the desire to build a lot of large nuclear power plants, to cite some advantages and significant benefits to the technology.
Talk to us about small modular reactors. Is that a solution?
Yeah, it is a solution because the dynamic has changed. In the past, we've seen, let's build large reactors to get economies of scale in size. The conversations talk, well, let's build a lot of small reactors and get down the learning curve as quickly as we can. So there are only 2 small modular reactors operating, modern ones operating in the world, one in China, one in Russia. China's building another one. Russia is planning to build another one, but they haven't yet yet broken ground on that. So it's a technology that presents a lot less risk to the utility or the hyperscaler who is buying it. There's no big deployment risk. There is technology risk because these are all first of a kind. And so with the first of a kind project, especially in the nuclear power business, there's a lot of uncertainty with regards to schedule and cost. And so people are thinking about this. A lot of utilities are making plans to go forward. The US and Canada and the UK are leading the effort. And so it's going to take some time before those first reactors, small modular reactors and advanced reactors, cross the finish line.
We know that new nuclear projects are coming online slower, but do you think this administration will change that, or is it going to be status quo?
The Trump administration, in its first term, was very, very pro developing uranium, the equivalent of drill baby drill from the uranium sector. And to a certain extent, that uranium has bounced back up. The current administration now is favorable towards nuclear. Chris Wright, the Secretary of Energy, has a pedigree from Berkeley and MIT, two of the leading academic institutions regarding nuclear. And I think that they are very pro-nuclear. However, the big question is how much government funding will be used to support nuclear reactor construction. That's something that we're still working out and trying to understand.
Chris, I finished the first season of the TV show Landman, so I now consider myself an expert in the oil and gas business. And I think my takeaway is, listening to energy providers and energy users, we're going to need everything. We're going to need fossil fuels. We're going to need the wind. We're going to need solar, all that kind of stuff, maybe nuclear. How do you think about that?
Yeah, my take is that we certainly do need nuclear. If you look on a geopolitical basis, you have China building 28 reactors, large reactors. They'll so soon surpass us, or post 2030, they'll have more nuclear power plants operating than we do. The Russians are very, very aggressively building nuclear power plants, not only in Russia, but in the Middle East, and establishing 100-year relations with that. And I think that has caused a lot of concern for the U.S. government, saying, hey, listen, we need to sort of offer a viable alternative option for new nuclear in the years ahead. And I think it's a very, very solid ambition. The Biden administration called for 200 gigawatts of extra nuclear capacity. That's tripling what we have right now. And so there is a tremendous need for it, and I think there has a place. It's not a solution for all of the problems, but it works very well for many types of applications.
Our thanks to Chris Gadomski, Bloomberg NEF lead nuclear analyst.
All right, coming up, we're going to break down the future of AI and powering data centers.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go in the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
We move now to the M&A space.
This week, we heard that the online mortgage provider Rocket is acquiring Mr. Cooper Group, the country's largest mortgage servicer.
It's an all-stock deal valued about $9.4 billion, and this will create a mortgage behemoth that handles 1 in every 6 mortgages in the U.S.
For more, guest host Isabel Lee and I were joined by Paige Smith, Bloomberg News consumer finance reporter. We first asked Paige to explain the latest deal and what Mr. Cooper is.
Mr. Cooper is best known, I would say, in the mortgage servicing side of things. Okay. So it's sort of after the fact, you've got your mortgage, but who are you actually interacting with, years down the line? It's actually going to be Mr. Cooper. But this is a big deal for Rocket because they've been trying to position themselves as sort of a one-stop shop for consumer finance offerings. So think credit cards in addition to your mortgage and, now theoretically your mortgage servicing rights. So it's a pretty big deal for this company based in Detroit. Dan Gilbert, a pretty prominent person in the finance. Yep, pretty big in sports as well. But $9.4 billion, it's a big deal for these folks.
We have Rocket also striking a deal to acquire Redfin, which is a real estate brokerage. How will that build into this one, or if they're even connected at all?
Certainly, it is basically sort of from a sort of nose to toe, if you will, of the home buying experience. Everything will sort of be under this Rocket umbrella. It, Redfin, as I think a lot of folks know quite well, is this platform for buying and selling homes, and it would be sort of a starting point for the home buying journey. Rocket is well known for originating or creating mortgages, and now Mr. Cooper is well known for sort of the servicing of mortgages. So it is kind of from start to finish of the home buying process, theoretically.
They got a lot of debt on their balance sheet because being a former banker, I don't look at stock market values. I look at enterprise value to include the debt. It's $18.5 billion because that's what you get paid on. You get paid on enterprise value. So that is a big number there. Talk to us about the mortgage business. I mean, doesn't seem like there's a lot of deals happening in the business.
Well, I mean, I think we can look at interest rates. It's been certainly been a tough time for home buyers and sellers, and that also weighs on these home lenders. It's a tough time for folks who kind of have put their eggs all in one basket, which is the home lending business. But that's kind of what Rocket has been aiming to do, is to really branch out and diversify their business so they're not so interest rate reliant or exposed, rather, which they have been in the past. And frankly, that's showed up in their earnings over the past couple of years. So I chatted with CEO Varun Krishna over the summer, actually. We did kind of a deeper dive into Rocket and the company. And one thing that he told me then was that artificial intelligence is actually a big bet they're making to really try to boost the business and make that home buying process truly as smooth as possible for the customers, to kind of amp up their offerings. And we'll see how it works out for them in the end. But so far, the numbers look pretty good.
Was this deal expected? Were you hearing chatter before, or did it completely shock you?
I was not hearing chatter before, and it seems like the market is responding in kind of an interesting way. But we're going to continue to follow the story and see how this kind of fits into the broader Rocket story.
Who do they compete against? Do they compete against the banks that make the loans, or the banks that make the loans usually just syndicate them away, right?
Well, I kind of take a different take on that.
Okay.
Since I cover consumer finance kind of broadly, I think of folks who are kind of trying to be that one-stop shop for the consumer finance experience. So for me, I think of, SoFi Technologies, for example. That is like they have a lot of lending opportunities for consumers, but they do a heck of a lot of other business as well. Robinhood, even coming at it from the investing side of things, now offering banking products for folks. That's kind of how I think about it in terms of competitors. But that's just from a fintech consumer finance perspective. When it comes to home lenders, other big folks in the space, I was just looking at some data by Inside Mortgage Finance that placed United Wholesale Mortgage as number 1, PennyMac as number 2, and Rocket as number 3.
PennyMac is what I use.
PennyMac, interesting.
That rings a bell. Okay. Dan Gilbert, just for what it's worth, kids, on the rich top list of Bloomberg, all the wealthy people, he comes in at number 62.
That's not bad.
Net worth of $28.7 billion, up $2.6 billion year to date.
Yeah, he's a force in Detroit, I would say. Some of our colleagues out of the Detroit Bureau did a great story on him last year, if you're interested, on the terminal.
Our thanks to Paige Smith, Bloomberg News consumer finance reporter. We move next to the artificial intelligence sector.
Guest host Norma Linda and I were joined by Jon Lin, Chief Business Officer at Equinix.
Equinix is the largest global data center provider and is listed on the Nasdaq Stock Exchange under the ticker symbol EQIX.
Jon Lin joined to discuss the future of AI and powering data centers. And I began the conversation by asking Jon to explain what Equinix does.
We're really the fundamental digital infrastructure provider of the world, building 268 data centers across 74 markets.
So you're the guys doing it.
So we are the guys building and connecting all of these cloud providers and enterprises, making all of that data available for AI.
And it's really interesting because I was just speaking with him during the break saying that I cover U.S. real estate stocks. I cover real estate investment trusts, and that's exactly what Equinix falls in that patch.
Okay.
This is my guy.
Yes.
So wonderful to have this conversation. But I think that there's often, people don't really, when they think about data centers, they don't often think about the people that are actually providing the real estate for data centers. So can you talk a little bit about how Equinix differs from maybe if you're thinking about a data center itself, but more or less the fact that you guys are acquiring properties and doing it that way?
Yeah, you can think about it as full scope development, where, I mean, we're going from raw land, getting their entitlements, and then building the entire data center and then operating that for perpetuity, essentially. And our focus is around making sure we're getting as many customers as possible into the facilities and really interconnecting their data flows together, which is pretty unique in the data center space, which has also been a great opportunity for us to participate in the AI growth.
Yeah. What are you guys seeing here? What are you seeing from your clients, the people you talk to, about kind of their needs going forward? Because right now, I think in the marketplace, if you look at like NVIDIA stock and some of the other stocks that trade around the AI theme, 2025 has not been a good year after obviously phenomenal, extraordinary growth in 23, 24, maybe even before that. How are you viewing the growth here in AI and from your end of the business, the real estate side?
Yeah, first, I'd just say, AI is a portion of the demand for data centers, but data centers as a whole are powering everything that everybody is doing, right? Like listening to this broadcast, ordering food for lunch, trading on the exchange, et cetera. I mean, you need computers for everything nowadays, and that's still continuing. I think, digital transformation is not in the early stages anymore, but we're far from done. And so that is just a secular driver that will continue. From the AI landscape, I'd say, obviously a huge amount of interest and excitement, and I think it caught the imagination of everyone. And I'd say right now what we're seeing is like exciting use cases that are really providing durable value, right? And I think it's still early stages for many of that across the general business landscape, but that's what gets me fundamentally excited. You look at a company like Bristol Myers Squibb, a customer of ours, they're doing drug discovery using NVIDIA GPUs and like being able to increase and accelerate their time to therapeutics. That's fundamentally going to improve like human life, right? And I think that there's so many different aspects that AI can improve based on that.
So run us through some of your biggest customers. Who do you all work with?
Certainly the cloud providers are some of our top customers. We've got over 2,000 different network providers as well. The genesis of the company was really around how do we help the internet scale? And that ended up being, well, how do we help the globe's telecommunications and data flows scale? And so when you think about all of the cloud providers, how do they connect to the end customers? That's through our facilities. Mm-hmm. And then as we've built that landscape, we've ended up basically becoming the place where enterprises put their most trusted assets. When you think about then when they have some workloads that are in the public cloud, well, they're going to have some that they're going to have ownership and control of themselves. When they put those in our facilities, it lets them glue that infrastructure together and become like one super powerful environment.
And folks, Equinix is a publicly traded company. EQIX is the ticker. It's got a market cap of $81 billion. And if you want some research on it and you're on the Bloomberg terminal, Jeffrey Langbaum is my REIT analyst. He covers EQIX, so you can go to BIGO, and that's where you'll find the research on Equinix. Jon, talk to us about the global footprint. We know you guys are global here. Where are you seeing growth, stronger growth versus weaker growth?
Yeah, I'd say across the landscape, there's still quite a bit of demand for data center activity. We're particularly excited about some of the emerging markets. Southeast Asia, for instance, is certainly growing quite a bit. But, based off of a lot of the recent surge in AI and kind of the use cases set up for that, just a tremendous amount of growth in the U.S. over the course of the last 2 years. Mm-hmm.
So, when we think about your competitors in this broader landscape, there's obviously Digital Realty Trust when we're thinking about publicly traded REITs here in the data center space. And if you look over the past 5 years, we have Equinix shares that have risen 40%, but that's compared to Digital Realty that's risen about 11%. What do you think that you all are doing differently than your competitors?
I think one, it's our focus around really driving diversity of customer and like kind of having an ecosystem that we've built around the value that we're doing. And so that's incredibly important for us. Like for the AI trade, for instance, we're focusing not just on capturing some of these large training footprints, but really how do we make sure we're getting all of these AI players and exposing them to the rest of our customer base? And really, again, that fuel becomes additional growth across our entire portfolio.
Do you develop and build data centers, or do you just buy existing ones?
We develop and build. Yeah.
Where are you developing and building these days? And if you say Texas or Florida.
Well, we're building all around the world. I think we've got 68 current major construction projects across. Really? Yeah, so we're very active.
Wow. How come I've never, well, I don't.
It's a really, it's a pretty big company in this. People don't think about REITs. You guys have to come to my patch.
I know.
It's a beautiful space.
So what is your, what are your thoughts for people who are saying that, the tech rally has run too far? Maybe we have CapEx spend that's just, bloated. There's so much spending in this space. Is this a place to be investing right now when we think about AI and in places of that regard?
I think the long-term trend around this is going to be inevitable, right? I think it's certainly we're creating durable value, not just for kind of the planet and all of our customers, but for shareholders. I think the amount of investment in the space and like the numbers are candidly like eye-watering right now, and so but a lot of that I think is just capital accumulation rather than deployment. And compared to a lot of other markets in the real estate side, it's actually a little hard to kind of overbuild just because there's so many natural like limiters in terms of the way we want to scale, from utility power availability to supply chain to kind of just the amount of trades you need to be able to build and operate these facilities. And so I think that helps kind of provide more rationality than in some real estate markets where you can throw up a shell pretty easily. You can kind of just like convert and overbuild. In this case, it's a very long development cycle, and so I think you'll see kind of some self-metering there.
Our thanks to Jon Lin, Chief Business Officer at Equinix.
Coming up in the program, we're going to break down the rising cost of food and how that's affecting the consumer.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We turn now to the restaurant industry. This week, guest host Norma Lind and I were joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
He joined to discuss the rising costs of food and how that's affecting the consumer.
We first asked Michael to break down his most recent research on restaurant spending.
Restaurant space is unique. We were in a restaurant recession last year.
Higher prices?
Yeah, higher prices really kind of, the low-income consumer kind of pushed back against higher prices, right? QSR has been raising their prices since 2020. The rest of the restaurant industry has been raising prices since 2021. So last year was kind of that restaurant recession. This year, we see higher income consumers with a better balance sheet, right? Crypto's up significantly. Home prices are still rising, right? And so, for that reason, we think that this is going to be a better year, and we still think so. And the data that we've seen and from a lot of the CEOs that we've spoken to, the weakness in February was broad-based. And to me, that's less concerning. I would be more concerned if they said, listen, low-income consumer pulled back even harder. The middle-income consumer started to pull back harder. That would be more concerning to me. Broad-based tells me that, well, it was really cold. We got snow all over the country, including Sarasota, right, and New Orleans. It was the coldest January in 13 years or so, right? And the flu was really bad. So for me, it really seems that people were just sick of the weather and sitting on the couch waiting for things to open up. We have some weekly data for early March, and data got better.
So what data are you looking at when it comes to consumer health? I know you said there's some that you don't really pay as much attention to.
Yeah, for the restaurant stuff, we use black box intelligence. We get very good industry level and sub-segment level same-store sales traffic and check data. When I'm looking at the consumer, it's kind of dated right now because it comes out quarterly, but I'm looking very closely at credit card balances. And so credit card balances, credit card delinquencies, auto loan delinquencies, they're still rising, but at a much slower pace than they were early last year. So it's a rate of change improvement. We're also looking at CPI declining, real incomes rising, and savings rates rising, right? And so to me, those are all good things for the low-income consumer, right? So, yeah, we're not so concerned about that consumer sentiment data.
How about tariffs? How's that impact the average restaurant if they're buying food and that type of stuff?
Yeah, listen, if you're a mom and pop shop and you're importing Italian or Japanese items, stuff like that, it could hurt, right? But for most of our chains, they're sourcing a very large majority of their products in the United States. Chipotle was one everyone was worried about. They're saying it's going to be like 30 basis points impact to their food.
So the block prices aren't going to go crazy?
Yeah, it's going to be like 30 basis points for the avocado prices, right? And for years, they've been expanding beyond Mexico in terms of sourcing. One of the companies that we cover that has probably the most exposure overseas is Darden. They said they actually import about 20% of their items. Part of that is they have an Italian chain, right? But also it's just cheaper for them. And so they're working on sourcing domestically and in other places to try to ease some of that pain. So even though it's a 20% number, it can be much lower than that. So the restaurants aren't going to be impacted that harshly.
How are consumers adjusting to the price increases? Are people just saying, hey, I want to go out, I want to eat, so I'm just going to pay more even still? Or are they a bit more resistant? If so, which groups?
It's a K-shaped recovery, right? And so chains like Chili's, I mean, they just posted a 30% comp in the United States over a 5% comp. We've never seen that before for a chain that's been around as long. But they're bringing in younger consumers, wealthier consumers that are willing to spend, right? And so the top slant of the K, people with money, they're doing just fine, and they're still spending at restaurants, right? It's the people on the bottom slant of the K. It's these chains that are catering to low-income consumers, right, that are getting that pushback. Either they're going to restaurants less frequently, they're doing more shopping at the grocery store, and when they do go to the restaurants, oftentimes they're ordering off the menu, or they're ordering less drinks, appetizers, desserts, and stuff like that.
Hey, Mike, how about labor? Real quick, 30 seconds. Busboys, dishwashers, migrant labor. Migrant labor's cut off here. Is that going to be a problem for some of these restaurants?
Well, it's a concern for the restaurant industry in general. Most of our companies are compliant.
They are, okay.
Right, and so they're not really too worried about it.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
This week, Bloomberg Intelligence hosted its 4th Generative Artificial Intelligence Conference, and there were some great lineups in terms of how you apply and make Gen AI.
For more, Alix and I were joined by Choi, CMO of Cerebras. We first asked Julie where she thinks we are with the changing views of AI.
Well, I think that AI is really kind of hitting the mainstream more.
Okay.
I think that, ChatGPT surfaced at the end of, was that 22? I mean, technically, I think the first model came out in 2022. And it's been almost 2.5 years since then. And ChatGPT has found its way into so much of our lives. And so people are more comfortable with AI, right? And so now I think we're just shifting into, okay, AI can be a part of my life, but it's still early days.
So where do you sit then in the pyramid for AI?
So Cerebras makes this beautiful chip, which is basically AI infrastructure. We are the equivalent of NVIDIA. So NVIDIA GPUs, it's just an alternative type of processor for AI. So we are the underlying compute that's powering the training and running of models like ChatGPT.
I guess one of the questions now is people are trying to just get a better handle on what the compute needs are going forward. Jensen Huang at NVIDIA remains extraordinarily bullish about that, and he has been, the voice of AI for many investors for the past couple of years. Where do you think we are in that compute need?
Oh my goodness, I completely agree with Jensen Huang. I've been following Jensen kind of unofficially as a mentor. I find him to be an incredibly inspiring leader. I agree. I think that the compute needs for AI are ever increasing. Now with models like GPT-4o, and the whole O1 series, these are like these reasoning models, right? I'm here in New York to go to the generative AI scaling event that Bloomberg is hosting, and it's all about this like inference time compute. Inference time requires a tremendous amount of compute. And so we're still just scratching the surface of how much compute is really needed for this extra level of intelligence.
And do you play in the inference and the LLM space, like the training and the usage? You do both?
Yes.
Okay.
Yes. So Cerebras is in both training and inference.
What is has demand for your products changed at all since DeepSeek came out in terms of pricing or in terms of demand?
Yeah, I mean, DeepSeek happened in January, and it was such a big moment for the industry. And we immediately, within 48 hours of the news, that big day, we added DeepSeek to our catalog of models. And so what we do is we offer Llama models, DeepSeek models, and other kinds of models to the developer community, right, in our cloud. And our differentiation from GPUs is that we're like 20 to 70 times faster in terms of like that response time. When you put in a query, our responses are about 20 to 70 times faster because of the architecture being bigger. So DeepSeek really created this moment of developers coming at us saying, "Oh my God, you guys have the fastest DeepSeek. We want to, we want that. We want to see what that can do." And that's led to a lot of prototyping. But what we do see is that when it comes to developers that are building AI businesses, there's a lot more usage of Llama. So Meta Llama is probably still the most popular open source AI model that is downloaded, at least from the Cerebras cloud. And then we have customers like Perplexity and Mistral, AlphaSense, based here in New York, that are kind of serving their adapted Llama models as well as their own custom models.
So the DeepSeek issue for the industry was, hey, here's this Chinese company coming out with an AI solution at a much lower cost. Is that good or bad, or neither good or bad for the AI evolution?
Oh, I think it's very good, because DeepSeek was a state-of-the-art model when it came out. It's still one of the best models in the world, especially I think with their V3. And what it proves is that when you can open source this level of intelligence, you're bringing kind of down the cost to developers, and it increases developer creativity. And so one of the things that Cerebras is super passionate about is providing developers with the best models, open source or custom, fastest at the best price. And so we were just very excited when DeepSeek open sourced, and clearly, the developers were very excited as well. It was definitely kind of an inflection moment.
In terms of what you're most excited about right now, what's the coolest use case you've seen when it comes to training and when it comes to inference?
Fantastic question. So for training, I'm going to bring up a healthcare use case. So one of our favorite partners, and we shouldn't have favorites, but I really appreciate the work that Mayo Clinic has done on Cerebras. They have been able to train world-leading foundation model using genomic data. And the point of their genomic model is to help patients of rheumatoid arthritis. I have a family member who's been struggling with this terrible disease for a decade. And this AI model can help her find the medicine that actually works much more quickly. I didn't realize that actually rheumatoid arthritis, generally 40% fail rate in terms of aligning the right medicine to the patient. And so really proud of the work that the Mayo Clinic team has done in partnership with Cerebras, training that model super fast on our chip, releasing it in probably less than 9 months of development time.
Wow.
On the training side. On the inference side, I'm very excited to be working with companies like Perplexity as well as Mistral. These are some very, very AI-forward companies leading the way in terms of disruptive search experiences for consumers and amazing chat assistants, especially in Europe. And we're powering their super fast results.
Your company, are you seeing any impacts of just the uncertainty surrounding how this tariff policy will evolve? And your customers saying, we're just going to wait a little bit before we place an order or something like that?
No, actually, it's really all systems go.
Okay, good.
Our customers want the fastest inference speeds. They want the smartest models in their applications. We're not waiting to find out. There's no time to wait. We have to deliver the fastest compute to the best customers in the world.
Our thanks to Julie Choi, CMO of Cerebras.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.